He says that basically there are two types of investors: the defensive investor and the enterprising investor. The defensive looks for safety and freedom from bother, but it's more emotionally demanding, whereas the enterprising investor aims for higher returns through active effort, and that's more physically and intellectually taxing. You don't have to be either one, you can always find a blend between the two. So here are some of the principles that Ben Graham points out for the defensive investors. You should not, when you're looking at companies to invest in, they should not have less than 100 million of annual sales, which comes to about $500 million today. Its current assets should be at least twice its current liabilities. Long-term debt should not exceed the net current assets. Some earnings for the common stock in each of the past 10 years. Uninterrupted dividend payments for at least the past 20 years. A minimum increase of at least 1/3 in per share earnings in the past 10 years. The current price should not be more than 15 times average earnings, and the current price should not be more than 1.5 times its book value. He argued that dividends are a sign that a company is profitable. Dividends are paid from profits after all, and they will offer investors a return even if company stock does not perform well. The more familiar a stock is, the more likely it is to turn a defensive investor into a lazy one. That's why defensive investors should diversify, as you have to make sure that you're not overexposed to one industry. Now when we look at the principles for enterprising investors, they're very similar but a bit more latitude as they're more actively involved. Again, the financial condition, the current assets at least 1.5 times its current liabilities, debt not more than 110% of net current assets for industrial companies, no deficit in last 5 years, some current dividend, last year's earnings more than those of previous year, price should be less than 120% of net tangible assets. Sound advice again, don't focus on the price, focus on its value. What he emphasizes a lot is you need a business-like approach towards investing, as stock is the ownership interest in an actual business with an underlying value that does not depend on its share price. Again, focus on the intrinsic value of a company. He says that never buy a stock immediately after a substantial rise or sell one immediately after a substantial drop. The market is emotional. Don't just dump a stock if its share price falls. Sell it only if you feel the business's actual value has dropped. Graham also argues that it's beneficial to thoroughly research and understand the inner workings of a company when an investor is considering buying shares and assessing the actual value of an ownership stake. Simply watching its ups and downs is far too shallow an approach. A quote by Peter Lynch: "Behind every stock is a company. Find out what it's doing."